So this is the review for Test 3, Commercial Law. As always, there are 50 objective questions. And remember that I ask that you remember certain questions from former tests. So up to 10% of the material may come from a former test. Commercial paper, secure transactions, bankruptcy, those are the topics. Let's look at a blast from the past, just so you remember these things. A couple things to point out. The statute of frauds does not require that all contracts be in writing to be enforceable. Only certain contracts must be in writing to be enforceable. Second thing for you to remember, a seller may disclaim or take away the implied warranty of merchantability by selling goods as is or with all faults. It also can be disclaimed or taken away with a conspicuous disclaimer that uses the word merchantability. All right, so here's the question. Does the following statement disclaim the implied warranty of merchantability? There are no implied warranties. And the answer is no. Forms of business organizations. Here's some things for you to remember as well. The primary disadvantage of a sole proprietorship is unlimited personal liability. Second thing to remember is that corporations have the disadvantage of double taxation of profits paid out as dividends. All right, so let's get going with commercial law. Commercial paper was our first topic. So you need to remember that in terms of types of negotiable instruments, there are two types of negotiable instruments. There are drafts and promissory notes. I also referred to promissory notes as just notes. A check is a special type of a draft that is always drawn on a bank. And you need to remember that a certificate of deposit, also known as a CD, is a type of a promissory note. So what are the characteristics of commercial paper? To be negotiable, you must have a writing in some permanent, movable form. It must contain an unconditional promise or an unconditional order to pay a sum certain in cash. And cash means cash. It doesn't mean U.S. savings bonds. You know that foreign currency is okay. Note, while pay to the order of is required for drafts and notes, a check may say pay to and still be negotiable. Order paper and bearer paper. Be able to identify what type of paper you have, order paper or bearer paper. Remember, of course, that order paper is payable to a specific person. Bearer paper, on the other hand, is created when an instrument is payable to cash or payable to bearer. If it has an endorsement, look at the last endorsement. That tells you what type of paper you have. If you have an endorsement in blank, that is, the holder just signs his or her name, then you also have bearer paper. So what's the significance of order versus bearer paper? Well, bearer paper is negotiated by mere delivery. And remember, negotiate means transfer. Order paper is negotiated by endorsement plus delivery. All right, so we talked a little bit about mistakes. And what if there is a mistake on a piece of commercial paper? So let's say the payee's name is misspelled. Does that create a problem? And the answer is no, it's still a negotiable instrument. What if the amount written out in words is different than the amount written out in numerals or numbers? Well, do you still have a negotiable instrument? And the answer is yes, you do. The amount written out in words governs. That tells you how much the instrument is good for. So here's some endorsements that we looked at. So the top endorsement is a special endorsement. Note that the instrument is still payable to a specific person, so it's still order paper. The second endorsement is an endorsement in blank. So here the person just signs their name. An endorsement in blank, remember, creates bearer paper. And then the bottom endorsement is a restrictive endorsement for deposit only. Banks and customer relationships. You need to remember these things. So this actually will give you 8 points on the test. An oral stop payment order is good for 14 days. A written stop payment order is good for 6 months. You can never stop payment on a certified check. And then a check is stale or an instrument is stale after 6 months. A bank may honor a stale check, but it is not required to do so. How about the forgery example? I know you remember this one from class. Assume that someone sneaks into your dorm room and they steal a check and they forge your signature. You notify the bank immediately. What is your liability? This is solely the bank's loss. You bear no liability because the bank is deemed to know your signature. Now, second topic was secured transactions. So if you are loaning someone money so they can go out and purchase an item, or you are selling someone goods on credit, you want more than just their promise to repay you. You want to enter into a secured transaction. There are 2 steps in creating a secured transaction. The first step is known as attachment, and the second step is known as perfection. So an attachment actually creates a security interest. To have attachment, you must have 3 things. Do you need to know all 3 things? And the answer is yes. There must be a security agreement, value must be given, and the debtor must have rights in the collateral. Perfection. Perfection is the status you are trying to achieve if you are a creditor. Perfection gives you the best possible rights that you could have in that collateral. So you must know the methods that a creditor can use to create a perfected security interest. First, a perfected security interest may occur when the seller has possession of the collateral. So when could this happen? Well, a pawnbroker. Another example we talked about in class was layaway. Second, a perfected security interest may exist if a financing statement is filed. And so that's probably the safest way to create a perfected security interest. A financing statement, by the way, it is filed in Virginia through the CIS system. It costs $20 to file it. And what is the purpose of a financing statement? Well, it alerts third parties to the existence of a security interest. I suppose the other way I said it in class is that it puts the world on notice that you have a perfected security interest in those goods. And then finally, with consumer goods, there's an automatic perfected security interest when the consumer goods are sold to the first consumer, and they must be for use as a consumer good, not office equipment. This perfected security interest, of course, may be lost if the goods are sold to another consumer. So it may be wise for you, if you are the seller or the creditor, to file a financing statement. Remember to look at where the goods are used to determine whether they are consumer goods or not. So if I were to sell Benny Bean, the accountant, a large flat screen TV for use in his conference room at his office, it's not a consumer good. This is office equipment. And then the last topic for commercial law that we covered was bankruptcy. And these are just the basics of bankruptcy. A Chapter 7 bankruptcy is probably what you think of when you think of bankruptcy. It's also known as liquidation. Some people call it a straight bankruptcy. There are 2 ways to begin a Chapter 7 bankruptcy. You could have an involuntary bankruptcy proceeding. That is one that's begun by the creditors of the debtor, or a voluntary bankruptcy proceeding begun by the debtor by filing a petition. My note to you is this: a debtor must now take a credit counseling course before you are allowed to file for bankruptcy. And then the third type of bankruptcy that we talked about was a Chapter 13, or an extended time payment plan. And this is only available to a debtor who has a regular income. All right, so involuntary bankruptcy, as I said earlier, is begun by the creditors of the debtor. If there are 12 or more creditors, at least 3 must sign the petition. And of course, you may not force a farmer or someone who owes less than $16,750 or a charitable organization into bankruptcy. Um, just a little note to you, well, when are involuntary bankruptcies used? They are primarily filed against businesses. It occurs when a creditor thinks that the business can pay its outstanding debts, but it refuses to do so for whatever reason. All right, so here's a hypothetical. Who must sign the petition? This is an involuntary bankruptcy case. Bill is unable to pay his debts as they become due, and he owes over $20,000 to 12 creditors. Green is owed $16,750. May Green force Bill into bankruptcy? And the answer, of course, is no, since there are 12 or more creditors. At least 2 additional creditors must sign the petition. A discharge in bankruptcy. You can only obtain a discharge in bankruptcy once every 8 years. And it's going to release the debtor from most debts. There are certain debts that are non-dischargeable in bankruptcy, and you need to know these because you will see a multiple choice question that asks you which debt is not dischargeable in bankruptcy. The Bankruptcy Abuse Prevention and Consumer Protection Act made sweeping changes to bankruptcy laws, and here are some of the changes that were made. The homestead exemption, that is the amount allowed under state law, is now limited to $125,000 for bankruptcy purposes. You must be a resident of that state for almost 2 years or 720 days. And if the bankrupt or the debtor obtained a discharge within the past 8 years, bankruptcy will be denied. And of course, the other change that I mentioned earlier is that the bankrupt must take a credit counseling course before you're allowed to file for bankruptcy. That's it for commercial law. Best of luck on test 3. Thank you.